3, 2, 1. How you doing,
All right,
Jerry?
blast off.
Here.
I am good. First week of December, I am doing a whole lot better than the market is. I can tell you that.
I know, right? Yeah. I'm a big fan of the holidays. Like I like Christmas. I like Christmas. I like Thanksgiving. I always eat too much, like everybody.
I'm a big Thanksgiving fan.
Yeah,
Yep.
but I'm like, and I wait, and I don't watch any Christmas movies until like the first week of December or whatever. I think that's where we're at. Like I even make the kids. I'm like, no, no Elf, no Scrooge, no. Now the it's
the Elf's on the shelf, right?
It's on. Well, no, that guy doesn't come out yet till we put up the tree, and we only got one kid left that even cares about the Elf, and she's not. Yeah. She knows better too, so she's just like, I'm gonna kill the Elf.
Oh, lots to talk about today, my friend.
Let's get into it, man. I'm excited.
So I got two little sort of pre-show things I want to kind of talk about. So the first one, this idea, it sort of highlights something I've been thinking about for a while, and I never really brought it up on the show, but we talk about contribution allocation versus interfund transfer, right? And, we talk about how your new money going into TSP, you do a contribution allocation and tells TSP where your new money is going to go. For the money that's already in TSP, which if you've been in for any amount of time, the bulk of your account is going to get moved, reallocated using an IFT, right? Interfund transfer. So I got a comment on Facebook, and it was it's an interesting comment. I'm going to read it. I'm going to read the response that I gave to the comment, and then the response back.
Okay.
It's a little bit long, but I'm going to kind of...
We'll work through it.
We'll work through it. Okay. So...
While you do that, though, I'm going to take a sip.
Okay, well, just make sure no one's like, they're not just staring at the top of my head while I'm reading the screen.
They're looking at both of us right now.
Right.
They're going to watch me take a drink while you talk.
Okay, good. So he says, I'm buying CNS while they're on sale. If you study the entire history of the stock market, every time the market crashes, it always, capital always, all caps, comes back, always. The key is to stay patient and buy the sales. When you buy the sales, those who buy the sales will be further ahead than those who did not buy the sales. If you Google thrift savings plan millionaires, the majority of TSP millionaires consistently invested in the CS&I, no matter if the market is up or down. They didn't hop back and forth between the G and CS&I. They simply stayed consistent and invested CSI. Consistency is patience. There are tons of wonderful companies on sale right now. I'm buying. So I thought that was
interesting
perspective. Yes.
Sure.
So I respond back and I say, hey, honest question here. People talk about this all the time, and I just don't get it. When we're talking about TSP, what do you mean what do you mean that you're buying the C and S when they're on sale? I get it that you can set your contribution allocation to direct your new contributions each payday to CNS. In that respect, you are definitely buying those shares cheaper as price declines. However, the bulk of your account is already allocated to one of the funds. The only way to use that money to buy when the CNS are on sale is to be in the G fund as the price is dropping. That way, you are in a position to reallocate to the CNS funds when they're on sale. Unless I'm missing something, question mark.
Yeah, because they're not on sale for your larger, the piece that's in the interfund transfer,
right?
Your fund, the money that's in your account is not on sale. It's going down.
Right.
Right. It's going down. That's what I am always talking about. Yeah.
Right. So I don't want to go down the it's going down road, but my point of this is that, like, let's say you are, you're getting ready to retire or whatever. Say you get $1 million in TSP, and you're still employed, right? You're contributing. Let's say you're over 50 and you're maxing out. So you're 19.5 plus the 6,000 catch up. You're contributing, say, 25,000 a year or whatever. So let's say it's 24,000 a year, and so 2,000 a month.
Yeah.
You're contributing to TSP, 2,000 a month. You have $1 million in your TSP,
and you're buying $2,000.
You're buying $2,000 worth of shares of the CNS fund on sale. Nothing wrong with that at all.
No,
I mean,
makes sense.
Absolutely, you would want to buy the shares when they're on sale.
But it's only $2,000 worth.
Right. That's what you're actually buying on sale.
Your $1 million, however.
Your $1 million, if that is also in the CNS when the CNS becomes on sale, yeah, you've lost whatever that loss is. The only way you can use the money, the million, to buy the shares when they're on sale is to have it outside of those shares so that you can buy it when they're on sale.
Right.
I mean, I don't think we've ever talked about it like this kind of on the show.
Yeah. And we've talked about it a lot personally.
Yeah.
Because it literally boggles my mind. And I'm not a very smart man. Like, I'm not. And when it comes
to... Dude, I seriously thought I was missing something here. Yeah. I finally had to go back and be like, look, I hear this all the time. Buy them when they're on sale. Buy them when they're on sale. Yes, 100%. Your contribution allocation, if your new money that's coming into TSP,
you're buying on sale.
You can buy on sale. Absolutely. Now, you don't have any control over exactly which day you buy it. That's a different thing.
Story.
That's fine. The new contributions you make when the market's coming down, you're buying stocks cheaper. You can call it the dollar cost averaging thing. Absolutely 100% true.
I concur.
But the bulk of your money in TSP, it just doesn't work that way. Mm-mm. Okay. So that was my response. So his response back. All of my contributions go to CNS every pay period. No matter if the market's going up or down, I'm buying CNS. If people would simply look at the entire history of the stock market, they would see that every time the market crashes, it always comes back. One of the hardest parts of investing is staying calm and being patient. Most people are not patient, so when they see the market drop, they pull their money out of CNS. Yes, some people can probably make more money hopping in and out of G and CSI, but I'd rather set it and forget it because it's been proven to work. I'd rather not have to constantly worry about timing the market. Last year, when COVID hit the U.S. and businesses started shutting down and the market tanked, I simply continued to invest in the CSI the entire year and came out of 2020 with a 61% gain. 61% is good enough for me. Yes, there might be some people who can constantly hop between the CSI and G and make 70% gains, but I'll gladly take my 61% gains without the added stress of having to constantly watch the market and trying to time the market every week.
A lot of things going on in there.
Yeah. I only want to talk two takeaways, right? So he doesn't want his lifestyle to be watching the market and making reallocation decisions. He doesn't want that.
But he obviously is doing it. Otherwise, why would be in the conversation? I mean, he's watching the market.
Yeah, sure. I mean, he just might
like to
watch. He's thinking about it.
I'm just making the point.
That, yeah.
I don't know if you're setting and forgetting it. I don't know.
Right, but I'll take it for what the answer is, right? Because
I'd be playing golf if I was setting and forget it. Yeah, I wouldn't be talking about it on Facebook.
Right. I agree, but if you
I'm not being smart.
The two takeaways for me out of this is he's saying yes. I always put my new money into CNS every payday, whether the market's going up or down. I have no problem with that at all. I don't do it that way, but it's just because for me it's easier.
Simplicity,
that's all.
Yeah, we've talked about that a lot. Yeah. I would probably, hindsight being 2020, it's always 2020. In a lot of my years, I kind of, if I could have maxed it out, I would have taken that approach. Like I believe in that approach. If you mix that approach with what you're getting ready to discuss now.
Well, with the big part of your money. Yeah.
I'm a fan.
Right.
I'm a fan.
Right. So the 2 points out of this really are the contributions, the new money going into CNS every payday. No problem. And the second part of it is he's saying, I don't want to worry about, he's called it timing the market, which is fine. If you don't want to do it, then his methodology is to be in the CSNI and let it ride. And that's fine. In that is sort of the acknowledgement, though, that you can't have it both ways. You can't buy shares on sale with money that you can't spend.
Yeah, doesn't work that way.
Yeah.
You have a lot less money to buy on sale than you would have had if you'd have pulled the G and then bought it on sale.
Right. The only way you can use the bulk of your money
is keep it.
Is to have it in the G so that you can buy things on sale.
And when I say keep it, I mean move it to G.
Right.
So one little thought on that, though, about the idea of so that's what year did he say he got 67%?
Oh, 2020.
So yeah, I know you know this better than I do. When was the last time like the market went negative? What year? 2018. I know
yeah,
just C Fund was negative.
Yep.
I'd like to see what his return was that year.
Sure.
Well, because it's we were just, we talk about this all the time. I'm happy. I am extremely happy for someone that has an unbelievable rate of return for a year. Okay. I am.
Sure.
But this is a 20-year game, 30-year game.
Yep.
And if you're going to talk about those years, I would appreciate it if you talk about the other ones.
Sure.
Not to be, not to be negative. I'm just saying, let's if we're going to say this is, if you're going to validate your methodology with 1 year,
right?
I'm not interested in talking.
Yeah.
I'm going to say, okay, well, what did you look like in the years on? Yeah. And I know you won't point this out, but I'm going to. We were positive that year, 2018, which means you beat the market.
Yeah.
Which is everybody says is impossible. And here's the point really is, I know you weren't trying to beat the market.
No.
That's never on your mind.
Nope.
Right? I know this, right? That's not on your mind. You're trying to be on the right side of the trend.
Yep.
And if it works out that way, hallelujah.
Right.
Yep. And it has, thankfully, for a number of years.
Not every year.
Yeah, it doesn't.
It doesn't always work.
Well, but but the caveat to that though, I would say, if you're talking about your performance, you're talking about years where it wasn't your day job to do it,
well,
right?
True.
Yeah.
Sure.
So I know this, right? I mean, I know there was years that you were running a business, fully employed, flying around the world, killing bad guys, all that shit that all of you out there do.
Yeah.
And our point is that we know not everyone has time to do all this stuff. Right. And so we're hopefully trying to do some of that for you, but I don't. I mean, so he never really got the point. I would assume in the post. I mean, you guys' discussion.
Yeah, that was pretty much the end.
Your old money, your big pot, is not buying as much on sales.
No,
you think?
I mean, he said that he says I'm using my new money and I'm always buying CNS, which is great. Yeah. And my old money, I'm letting it ride.
Yeah. I guess if it comes to a buy and hold strategy, well, really, there's no strategy there. He's not just buying new money. He's buying it with both. If I hear correctly, he's both IFT and contribution allocations are all going CS&I. Whatever his distribution is, right. It's not different for those. Right, it's the same.
Right.
So it's not really a strategy. It's just I'm just hoping that the market goes up.
Yeah.
Okay.
Yeah.
Let's move on.
Okay.
You probably did enough there.
Okay.
I think it's I would like to go back to, and I hope there's people that realize that if you want to take a step further on the stuff that we talk about, our methodology, I think that a step further is taking IFTs. Contribution allocations, right?
Yeah.
And maybe directing those on these big downswing, trying to buy cheap.
Sure.
Trying to buy it.
I mean, if I could.
I mean, actually, we're not putting new money in, so we're not looking at it that way, right?
There's a couple of things I was thinking about this week, though, in terms of TSP. I mean, if you could put in a stop loss on awesome. TSP, could you imagine the game changer that would be?
Phenomenal. And if you guys don't know what a stop loss is, just Google it.
We're going to talk about it.
Yeah. Okay.
Yeah, it's actually the next kind of thing.
Maybe they'll give us that option in this new.
Maybe I didn't see it in any of the readings, but that would be awesome. I doubt it, but it would be awesome. But just to stop losses anyway. Okay. The first sort of pre-show thing I wanted to talk about was contribution allocation and interfund transfer. Okay, the second thing here is money management. Okay, trading rules. If you look at John Bogle or Warren Buffett or any of the names that people love to throw around, they all have rules. They're all different rules. Some of them are consistent throughout, and one of the rules that is always consistent throughout is some kind of exit strategy. There are all kinds of different entries you can have, but everybody has some kind of exit strategy. Either you set a stop loss, you have some percent loss, some dollar value you don't want to go below, but there's always.
And we call it a line in the sand.
We call it a line in the sand.
People, right. If you hear us talk all the time, that it's the same thing. We're talking about some line in the sand where I'm going to make a decision point. Or it is a decision.
That's the line of sand. The decision's already been made, right? So here's an example. This was hopefully IBD doesn't get mad at me, but I put the link down there for anybody that wants to see it, you won't be able to get to this chart unless you pay the $75 a month that I pay for the
at least
service.
you're giving credit to them.
Give credit to IBD.
Hopefully they don't sue us.
Okay. So this is a chart of Nucor Corporation. Okay. It's, according to Wikipedia, it's a producer of steel and related products based in Charlotte, North Carolina. It's the largest steel producer in the United States, as well as the largest mini mill. I don't know what that means, but it's in quotes. Mini mill steel maker. It is also the biggest recycler of scrap in North America. It is also one of only about 15 IBD leaderboard stocks. So leaderboard stocks, in this case, it has a relative strength rating of 93. There are a whole bunch of fundamentals that go into it to get you on the leaderboard. So Nucor on the leaderboard, and these, obviously, all the writing on here is IBD. I didn't do any of this. So Nucor tops out, does this rounded base, right? Basically a cup and handle pattern. And here's the handle. IBD's first entry point is when price pops up here above the 50-day moving average line. Okay. The second entry point, after it makes a high, it doesn't get above the prior high, but it makes a high and then comes down and starts to base. So the second entry point up here at 119.42, that's when you want to buy it, according to their methodology. So if you bought it right there at 119.42, the day after you bought it, it started going down. Okay, it's one of the best companies in the United States. And this is the chart from today. One of the best companies in the United States. Price goes down every day after you buy it. At some point, it hits your trigger. IBD's trigger is 7% below the entry price. It hit 7% below the entry price on the day that it was trying to find support at the 50-day moving average line, and it didn't do it. So IBD puts out a sell signal for Nucor. The next day, it goes down a little bit. So you're like, okay, great. I'm glad I'm out of that trade. And then it goes right back up. Right? So you bought it at 119.42. You got out of it 7% below that. So what is that, 105-ish? So depending on how many shares of it you bought, you lost 7% of however much you contributed to Nucor on that trade. And then it came right back up. Does that mean it failed? Does that mean that because it came back up, you were wrong in having a rule that said if price falls below 7%, that's my line in the sand, I'm getting out? The answer is, of course not. And we're going to, although this looks like the bonus chart, what would ordinarily be the bonus chart, the bonus chart is going to be VXF, which is actually an ETF for our S fund. Mm. And you might wonder, why would you do basically the S fund as a bonus chart? You will get a chuckle and you will appreciate it. But remember back to this, because it's another example of why you have buy rules and sell rules. Okay. Oh, and the biggest thing, obviously, take away from money management rules, if it had continued down, you're capping your losses at 7%. You need money to be able to make another trade. Mm. That's the point. You don't want to take this.
Yeah, their viewpoint is that that's all they were willing to lose.
Yeah, that's the rule set.
7%.
If it hits 7%, I'm out. Yep. That's it. There's no ifs, ands, or buts about it. Hit 7%, I'm out, and I'm moving on to the next trade. That's it. Okay. So, what are we going to do on the show? We had a request for what is this thing called the dead cat bounce, and we're going to talk about that. And the inverse of that actually is called trying to catch a falling knife. They make some pretty colorful.
I just wonder who comes up with this.
Yeah, I don't know. It's not me. It's not me.
Can we come up with some for the TSP? Just
we should
make some stuff up. That'd be fun.
And then we'll look at the primary and alternate Elliott wave counts. I know some people aren't too don't give very much credence to Elliott wave, and that's okay.
Yeah,
it works for me.
That's only a few people.
Yeah, well, whatever. Whatever floats your boat.
Yeah.
Like I said, bonus chart's going to be VXF. We'll look at the 2-year weekly charts, and then, much as I hate to even think about entertaining this question, I think we have to talk about it. What should I do now? Okay. Dead cat bounce. This was from 2008. The link to the guy's blog, that I don't know if the original picture is from that blog, but this is a pretty interesting. He does a pretty deep dive into how do we make money on a dead cat bounce. But here is kind of the first part of that blog. So the phrase dead cat bounce, commonly used in the finance industry, refers to a small, short-lived recovery in the price of a security after a significant downtrend. This recovery is sometimes mistaken for a genuinely positive indicator and pounced on by value investors looking for a stock that seems to be making a turnaround. The origin of the phrase can be tracked back to the ancient Mesopotamian proverb implying that even a dead cat will bounce if dropped from a great enough height. Aside from the ignorance of cat physics, what this phrase implies is that a security, meaning the dead cat, is still dead, regardless of a brief upward trend, the bounce. Investors are advised not to overlook the fact that the underlying weakness and poor fundamentals of the security haven't changed, despite the security's recent upward momentum. In fact, several analysts recommend shorting such a security during the acceleration of a bounce. So, dead cat bounce, right? My pen again.
Your pen doesn't love you.
Pen's not working for me. Here we go. The bounce. This is always the question. If I'm here, is the market going to go higher or is it going back down?
Mm.
And the yeah, I don't know either. But the answer is that you can see it in the underlying in the post. He says the underlying fundamentals. The kinds of fundamentals that I look at are: does volume decrease as the bounce is happening? Right? Are less and less people buying into the bounce? It's probably a dead cat bounce, right? We're gonna get it in the S fund. The S fund has done a ridiculous drop, and I guarantee, and I never guarantee anything, I guarantee you there's going to be a ridiculous backlash on the S fund, and it's going to, not necessarily to new highs, but there will be a back snap that would be great to get into.
Yeah.
So that's the dead cat bounce, right? This is what it looks like kind of in real life. It's not one bounce down, right? We had the C fund. This was the top. This is a basically 2 weeks where each tick is 15 minutes. Okay, so it's dead cat bounce isn't just on a daily or weekly basis. You can look at it minute to minute, whatever. Each tick here is 15 minutes. On Friday, last Friday, so the day after Thanksgiving, the market gaps down, right? Bottoms out right here, gives us a little ABC correction, and then went flat. And it also, if you drew the trend line, it hit right to the top of the trend line. So, and then it gapped down, not surprisingly, because everybody who's looking at this time frame saw it as exactly what it was, a dead cat bounce. And then what happened? It rolled lower and made new lows. And what happened again? We get a run up, we get another ABC correction, a run up, hit the downtrend line, dead cat bounce, new lows. And what happened today? Yesterday we came up and finished at the high. And today, so yesterday finished at the high for the dead cat bounce. Today rolled over again.
So that cat bounced a few times.
Cat bounced. Yeah, I feel for that cat. Okay, so that's kind of what a dead cat bounce looks like in real life. So what's the opposite of a dead cat bounce? It's this idea of trying to catch a falling knife, which is kind of what I was just alluding to in the S fund. If the S fund is really, really down right now, right? At some point, we know the snapback is coming. If I'm at my computer watching, now I'm not trading TSP. I'm at my computer and I'm watching, and I know this bounce is going to happen, and it's going to be a big one. And I can sit there on my computer and watch it start to happen and hit buy. I'm going to be a rock star that day. I mean, there are people that made a killing today shorting the market, an absolute killing. This is how people, high volatility is how people make money in the stock market. We can't do it.
Yeah.
It doesn't work that way for us.
Yeah.
This is okay. So from Investopedia, falling knife, a security or industry in which the current price or value has dropped significantly in a short period of time. A falling knife security can be rebounded or it can lose all of its value, such as the case of a company bankruptcy where equity shares become worthless. So the falling knife idea, the market comes down. You're trying to buy it. You're trying to time it. This is literally what you're trying to do is time the market and buy it. So you're like, all right, as soon as it starts going back up, I'm going to get in. Then it rolls over and went to newer lows. So, and then it kind of went sideways and went to newer lows. And we have this series of potential attempts at catching a falling knife. But at the end of the day, it just keeps going lower and lower. And so the idea of, hey, I just took a 2% loss, the market has to come back tomorrow. That's the point of trying to catch a falling knife. You don't know how far it's going to go.
Right.
So unless you're literally on your computer watching it, and you have the ability to do it, which again, we don't in TSP, if you could do it, you could sit there and see the turn happen and buy it.
And you could also jump out.
Yeah, and you can jump right back out.
But you're going to have to be staring at it.
Yeah.
And you're going to have more than 2 moves a month.
Yes, right.
And the noon.
And all that. Yeah. Okay. So let's go to the Elliott wave counts. Okay. This is still my primary count. We had 1, 2, 3, 4, 5 for 1. That's very clear, and it's I don't think anybody would argue with that. Then we had the first major correction since the low from COVID, and that's the 2. Then we had an extended 3 for 1, 2, 3, 4, 5, which gives us the 3. We're now in this wave 4 correction. Ordinarily, or by the book, I shouldn't say ordinarily, but the textbook answer to this is wave 4 should finish somewhere in the area of the low of the prior wave 4, right? The wave 4 of lesser degree, which in this case is right about 4,200. So I'm expecting, if this is my primary count, if this primary count plays out, before we get back up to new highs, we do some kind of, it won't go in a straight line, it'll come up a little bit and then come back down, ideally in some kind of ABC correction, down to somewhere between 42 and 4,300. That's my best crystal ball as far as that goes. And then I think we get a 1, 2, 3, 4, 5 higher to a 5. And once we get there, we'll talk about that when we get there. But that's what I think we're looking at going forward. That's my primary count. It's a guideline. It doesn't mean that's what's going to happen. It's just my map.
Yeah.
Basically.
Right.
So I have an alternate map. Okay.
As you should.
Of course.
Yeah. I mean, I think
it's like having a spare mag. You got to have an alternate map.
Right. Well, a spare mag is just, more. But that's not an alternate plan. That's just continuing the plan.
Well, you could have your throwaway. Yeah.
But I like your map analogy because that's a lot of times that's kind of how I think of this, right? When I was in the military, I used to tell people, how good is a compass without a map? How good is a map without a compass, right? When you put them together, like now it's very useful.
Yeah.
Right. And so I kind of look at these charts, the Elliott wave pattern is kind of a combination of a compass and a map, right? I kind of know where we're going now. And what I'm looking to see is if the terrain changes, maybe I'm off azimuth. Maybe I need to take a look at the map.
It's a decision point. Yeah,
it's all it is. It's like, okay, I see things are changing,
There's so many similarities to a bunch of different things you could point to, and that's a good one.
Yeah, it's not that we hang our hat on Elliott wave. It's just that by and large, as an indicator, it's a pretty darn good one for I would say definitely for long-term trends.
Yeah, much better for long-term.
Which again, that's the game we're playing.
Yep.
20, 30 years.
So, okay, here's the alternate count. And honestly, I think if you Googled Elliott wave, this would be more likely what would show up. I think more people kind of think that instead of the 2 being here, that the 2 is here. If that's the case, then we have this one big extended 3, and the September correction is the 4. And the October-November rally we had is the 5, and we're done. So people think this is what's happening next. I'm not convinced.
You're a little more optimistic than that.
You wouldn't think so by you wouldn't think so by the comments I get. I'm supposedly the most conservative. Like, I don't get it. I just don't get it.
You're risk averse in a lot of cases, but for the right reasons.
I'm risk averse when the market tells me to.
Right,
I'm not risk. I'm not risk averse.
This guy just swam the Boston Harbor.
Yeah, I'm not risk averse. That's not my.
Swam the Boston Harbor with a bad ticker.
Yeah, with a bad ticker is right. Almost freaking
shouldn't
killed
have done it. Yeah, he's not risk averse, but makes decision based on data, not emotion.
Yeah, which makes me risk averse. I don't get it. Yeah. Anyway. This is the alternate chart, the alternate count, and we'll know for sure if that's true. If the market continues down, recovers, continues down, and closes, below 4,200, then yeah, we're in this 1, 2, 3, 4, 5, right? That's when we'll know for sure when when we draw these trend lines and we get a serious break. That's when we'll know for sure. So that's the map. Two possible maps. But in the short term, they're both basically pointing in the same direction. There's going to be we're in the middle of some kind of correction, right? That's really the takeaway. Whether you look at it, if this is the 5, if we have seen the top of this rally since the bottom in COVID, then the next major move is down. It only may be a few months, but the next major move is down. If we have only seen the top of the wave 3, the next move is still down. It's just that the move after that is going to be up. And we're not going to get something like that. And so I still think this is the primary count. This is my primary map. If it's this one, we'll know it and we'll deal with it. Okay. So this is funny because some of the stuff we've been talking about, it all kinds of feeds into this bonus chart. So VXF is the ETF for the S fund. If you wanted to buy the S fund in a brokerage account, you would use VXF. Okay. So this morning, I had nothing better to do. Sure, I didn't.
Yeah, that's not true.
No. So I wanted to see. We had a big rally yesterday in the S fund. We had a big drop for a couple days. Then we had a rally yesterday in the S fund, and I wanted to see if I could play this somehow, because the big moves is what gives you an ability to play it, right? Mm-hmm. So I get on there, and I'm looking at a 1 day, 2 day. So the second day is over here. It doesn't really count, but. So this was yesterday. This was Thursday. And this part here is Friday. Okay, so all this is Friday. So I'm doing this Friday morning, as you can tell. It's, before 10 o'clock. I think that's the 10 o'clock line. So it's before 10 o'clock. So what happened? I'm watching the market open, and you see the little dot right there. That's where the market opened, okay? And this is a 3-minute chart, right? So each tick is 3 minutes. So inside of that 3 minutes, the market shoots up from, 182.25 or wherever to over 183. And I'm looking at the bigger picture of this, right? I'm connecting my trend lines, and I got an ascending triangle. And I know it's generally, an ascending triangle generally resolves down, okay? But it doesn't always resolve down. So I'm looking at it and I'm like, wow, that's a monster breakout, right? So I buy it right there. right, it was like 182.60, I think, is where I bought it. And as soon as I bought it,
not in the TSP.
No.
Yeah.
At my Fidelity brokerage account.
Right. I just wanted to point
at my kitchen table on this.
Just to play it like a regular stock.
Right. To play it like a stock. Yeah. So I have my pattern. I saw a breakout, and I bought it right there. And I'm watching it. 3 minutes later, it's down here. It's still in my pattern. So I have the initial pattern that I'm looking at, right? The initial ascending triangle. And then I'm looking at, okay, I basically could either say this is the channel that it's in, more short term, or I can say, okay, it's hit all these bottoms right here at 181.50, right? So I chose to have just under 181.50 be my line in the sand.
Mm-hmm.
At 181.49, I got stopped out. Okay. I'm like, shit. I was in at 182.60 and I got stopped out at 181.49. So whatever, $1 and some change per share. I didn't do the percentages and all that. I'm not sure how much I lost.
Yeah.
Not a significant amount of money.
Right.
Had on this huge breakout out of that pattern, had we had a big rally today in the S fund,
right,
I'd have made a lot of money,
sure,
right? But I didn't make very much. In fact, I lost. I got out right there at 181.49. By here's 10 o'clock. And I don't have an updated chart because by 3 o'clock we're down here. I can't even get that low. But within 10 minutes or whatever, I'm looking at this and I'm laughing. And I'm like, all right, I'll take my losses. Yeah. I'm happy to have only had, this little loss here. So it goes back to the first slide the second slide of money management. And I could have said, you know what? I know it comes back.
I know it's going to do it.
It's going to turn back around.
I know it will.
And it will.
Yeah.
I'm just not taking the loss. It will turn back around. And on Monday, will I sit at my kitchen table and look at the S fund because it is insanely oversold right now?
Right.
Yes, I will.
Yeah.
I'll be sitting there looking at VXF on Monday morning, and if it gives me some kind of consolidation pattern and a breakout, I'm going to buy it.
Right. Yeah. Don't you wish we could play that game in the TSP?
Well, next summer
we're going to see.
We're going to see, because when the mutual fund window opens, brother, there's going to be money to be made.
Yeah.
There is. Unless, of course, it's the government. Unless they screw up the rules, then that's the way it goes.
Now you're sounding like a government employee.
Please. Please. I thought I've outgrown that by now.
Just the pessimism.
Yeah. Okay. TSP fund charts. These are the 2-year weekly charts. C fund was down 1.22% for the week. Let me zoom in here a little bit. We closed below, that's the 10-week moving average line, the blue line. It roughly corresponds to the 50-day moving average line. Obviously, it could have been worse. The last 5 minutes of Friday, the market rebounded a little bit. It did one tick on a 15-minute chart. It did one tick below 4,500. It was 45.95 for about 5 or 10 minutes, and then it came back up and closed up at 45.38. That 4,500 line, I think last week we put out a piece of JC Peret's blog post, and I think the title of it was the chart heard around the world.
Yeah.
And it was IWM, which is pretty close to our S fund, not exactly, but pretty close. And it had broken out, right? The S fund broke out on November 4th, and then a couple days later rolled over hard, and it's still going, right? Still going down. But last weekend when he put it out, everybody saw that breakout, and everybody bought it, and it rolled over, and everybody saw that rollover too.
Got right out.
Yeah, well, either you got out or you didn't, but that was definitely the chart heard around the world. If if we break below, if we get a close below 4,500, so we take out that high and we close down here below 4,500, this is next. That's that 4,300 level. That's next. That's a pretty big move down. But if that gets broken, it'll be interesting to see what's going on in the world if that happens. But we had a pretty big volume on the down week, 2 consecutive down weeks. Technical indicators definitely are not giving us any reason to get back into the stock funds. So C fund is not looking very good. S fund is a frightening chart. This was the week of November 4th. November 4th was the actual day, but this is a weekly chart, so that's what that week looked like. Obviously, you can see that it broke out, clearly broke out of that pattern that we've been in since February, right? We topped out here in February to this sideways consolidation pattern and broke out in a big way that week, and then it rolled right back over. So you had a lot of money betting on that breakout, and a lot of people lost a lot of money in IWM. And it broke down below, over the last 2 weeks, broke down below both its 10-week and 50-week moving average line. So, and the indicators are, actually, this is kind of an important one. The relative strength still has some way to go before it gets oversold. I mean, back here at the low in COVID, that's the last time we came anywhere near getting oversold. We just crossed, on a weekly basis this is, but we just crossed on the MACD. The technical indicators certainly have room to go much lower. So from that perspective, I'm not saying that's going to drive prices down. It's a reflection of price, but there's certainly room to go lower. iFund last week closed right below its 50-week moving average. It didn't move all that much this week, but it was a down week, and it was down on pretty big, significantly big volume. And last week we talked about a potential head and shoulders. If this is a neckline, this is the left shoulder of the head, the right shoulder. If it breaks the neckline, which I wouldn't consider this week a break because it closed basically right on it. But the distance between here and here would be the same distance as here to here. So somewhere around $70 would be the target. So we'll see how the iFund rolls out. But again, indicators not looking like a place I would want to be right now. F fund. If the F fund wasn't so completely tied to the Fed decisions, this is a pretty good looking chart. You have a triangle, right? It doesn't go in a really straight line, but you got declining higher highs or lower highs. So you got lower highs, you have a high here, lower high, lower, 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 right? But you also got higher lows. We call this the low, and we call this because it's a pretty significant flat base. It's been based there since the end of September. So we got a pretty serious flat base, significantly above the prior low. And we got a breakout this week, and it was on support at the intersection of its 10-week and 50-week moving average lines. The indicators are turning up, and we had a big volume up week. It's an awesome looking chart. The problem is, the problem is it is completely attached to the Fed and interest rates. So the market is telling us that interest rates are not going up, they're going down. The price of the bond is inverse to the yield. So when the rate and yield is the same thing. When the rates go down, the price of the bond goes up. So in our case, the price of the F fund goes up when the yield the interest rate goes down. So everybody's talking about how interest rates are moving higher. The market does not believe that's what's happening. So if the Fed decides to do something crazy, it goes one of two ways. It's too much like a stock in that it's attached to too much of. There are too few variables in the F fund that can really affect it. It's almost more like trading a stock for me. And this is how I would kind of describe it, because I know the Fed action, and it's a reflection of interest rates.
Right.
And so
it's not necessarily like an index that has 500 companies in it.
It is. It's just that it's the aggregate bond index. And so all bonds are affected by the interest rate movement.
Right. That's what I mean. Like, they're not going to be those 500 companies in the S&P, each individual one has things that drive it.
Right. And different things in a lot of cases. Right. That's not the case in the F fund.
Yeah.
So as much as I like the chart, and I would be surprised if we don't get this question from people that don't watch the show, but why did you reallocate to the G fund and not the F fund? Well, number one, the F fund doesn't give very good rates of return.
Yeah.
I only park my money in the G fund when the stocks are going down. So the F fund, unless I really like the chart, it doesn't make sense to me.
And historically, if you go back and look at our allocations, you can see there what time frames Jerry was in the F.
Yeah, definitely.
And
yeah, I would be in the F fund now. It's just that the Fed right now is so crazy.
Yeah.
Interest rates, there's no trend for the interest rates right now, and so there's no trend for the F fund, and so I'm not buying it. And usually it's not worth it anyway, because you get a guaranteed small rate of return, but it's guaranteed.
Yeah.
F fund, you can lose money, and if I'm going to be out of the stock funds, I want to be in a place that I'm absolutely not losing any money. So
Roger that.
Okay. I might have to take a sip before this.
Yeah, I'm used to going question slide.
Yeah.
You got me.
Question's going to be last, but well, I have that slide on here too, but this is really the end. So
let's get into it. Let's do it.
Okay, I just wanted to read like a little disclaimer. Yeah.
What do I do now?
Yeah, I know. Let me just read a little disclaimer. To be very clear, we do not give personal financial advice. Grow My TSP is an education company. Our goal is to teach government employees and military service members how to use technical analysis to make reallocation decisions that are right for their personal circumstances and risk tolerance.
And there's going to be people out there that go, "Oh, why are you just reading that out?" Because every one of those words matters.
Yep.
If you have any understanding of this industry, which it's okay if you don't. That's the whole reason we're here, is because we know that there's a lot of people that don't, particularly in the government and the military. Yeah. Legally, there's lots of reasons we have to use certain language, right? So please don't scoff at the fact that we give this disclaimer. No, we have to. Yeah. And
I want to add on something to that disclaimer. We are not a financial advisory firm. We're not. The fact that we're not does not mean that we're not licensed and able to do it.
Ding, 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 ding.
Right?
I'm glad you added that.
Yeah.
Glad you added that.
I mean, a Series 65 exam is what you need to pass to establish a registered investment advisor.
Yeah.
We passed the Series 65 exam.
Yeah.
We have plans to start an investment advisory service.
Sure.
The fact that we don't have it up and running does not mean that we're not licensed to do it.
Right. And the only reason, I wouldn't say the only reason. Yeah, no, I might take that step. The only reason we are, growing the services, pun intended, is because we had so many people ask us to.
Yeah.
And we've always turned people away to go to other advisors. And what we know, right? This is what we know. Those advisors are not going to give them the time of day.
No, can't. Most people can't bring enough money to them to make it worthwhile.
If you're one of the TSP millionaires and you want to give your $1 million to a financial advisor, they're going to like you.
Yep.
They're going to give
Absolutely.
They're going to buy you lunch. But if you got $500,000 or less, forget about it. No. Forget about it. And even then, I know people that give $1 million to an advisor, and they hear from them once a year.
Yeah.
And that's normal. Right.
There's certainly no transparency. And
my God, they're not going to tell you what they're doing. First of all, they don't know.
Right.
First of all, let's just be clear.
Yeah.
Your normal RIA is not managing your money.
No, he's a sales guy.
Right. He's a sales guy, and he works for a company.
They put you in a bucket based on your risk tolerance and blah, blah, blah.
Okay, if you guys watch our show enough, you hear this. But if you haven't, what we're saying right now is very important, okay? And so 2 things to take away from this. One is, in this capacity, we are not financial advisors.
Right.
But don't mistake that for the fact that we don't know anything about what we're doing, right?
If you want to be a financial advisor, the way you make money in your business is to charge people a commission either on you buy and sell stocks for them,
right?
Or you have a percentage of their assets under management. You take a percentage of that. You can't do it in TSP, right?
Doesn't work.
They don't allow it.
Yeah.
So that's why there aren't any financial advisors that take you on as a client to manage your TSP, because they can't do it.
Yeah, and we purposely designed this way because we thought education is more important than advice.
Yeah.
Right. It really is. I mean, I don't know a better way to explain it.
Everybody's circumstances are different.
So there's a thing called an accredited investor. If anybody knows what that is, you know what that is. And I think it's a silly thing, and the system built it, right? What I would much rather have, right? What I'd much rather be a part of is a bunch of educated investors, right? If you're an educated investor, you are far better off for you and your family than most of the things. I spend a lot of my time, and I know Jerry does too, because first of all, this is how he grew up. I didn't grow up this way. In my family, investment discussions were not common, right? In your family, they were, and this is what led you down this track. But that is one of the most important discussions you can have with your children is investment discussions. And my kids have IRAs already, right? All of them. And they're actively managing their IRAs. And of course, they look at Uncle Jerry, see what he's doing, but that doesn't mean they're going to follow what he's doing. They got but the point is, educated investors are better than uneducated investors. Carry on, 100%. Sir.
Okay. So, all right. So the question, what do I do now? Obviously, it's related to what do I do now? And the market's off, whatever, I don't know what the S fund is off, whatever, close to 10%. C fund's way down, I fund's way down. What do I do? First of all, it doesn't matter if you're right now 100% in the stock funds or 100% in the G fund. You are where you are. You should be asking that same question no matter what. I mean, I just told you the answer to the question of what do I do now personally. I wake up Monday morning and at 9:30 and I'm sitting in front of my computer, and hopefully my trade on the VXF goes better on Monday than it did on Friday. That's what I'm doing now, right? The answer is that you have to do what works for your circumstances and allows you to sleep well at night.
Nobody wants to hear that answer, Jay.
I know that. Everybody, when they say, what do I do now? They want someone to tell them what to do with their money so that either they can stop the hemorrhaging or make money in this market, right?
Yep.
Anybody who gives you an answer to that question, you should run. You should sprint away from.
At least be wary.
Yeah, very, very wary.
Yeah.
I mean, because they must have a great crystal ball.
Yeah. Because where you are is where you are.
Yes.
And so if you're tracking with what we're talking about, if you're you're waiting for a trend change, and so that's what we're waiting for is a trend change.
Right.
And if we had seen one, we would have reallocated.
Right.
And we haven't.
Right.
And so, and I say trend change, I don't mean daily, right? Yeah. We're looking for what we would consider a long-term trend change, which is something that we expect to last for weeks.
Yeah.
Normally weeks. We hope they last for months.
Yeah.
Especially if it's going up.
Yeah.
But we're looking for things that are going to last a week or so, not a day or so. Is that fair?
Yeah, you can't. I mean, looking at something for a day or so is essentially trying to catch a falling knife.
Yeah.
Or
catching a dead cat
catching
bounce.
a dead cat bounce. I mean, it's one of those two things. You got to let it play out enough so that you can see a change in the trend on whichever time frame you're looking at.
Yeah.
So yeah, if you're basically apply the technical analysis tools, make a decision, and move out, and then anticipate what your next decision is going to be.
Yeah. Do you have a chart for this, or is just
no, this is just us?
So what I think a good takeaway here is for people, if we were to, back up to let's just take the CS9. Jerry just went through those 3 charts currently of where they're at. Yeah. And so if you just draw a trend line or a channel line with the current circumstances as they are, just do that. Forget Elliott wave and Fibonacci and everything else. If you just draw a channel and then Monday morning, watch and see what it does. Yep. If it breaks that channel, if it breaks your trend lines, now you need to start thinking about your decision points, right? That doesn't mean you immediately get in or immediately get out. Right. Let's see what it does. Yep. It doesn't, this is a long game. But do that simple thing. I challenge everyone that's watching this, all 5 of you. Thankfully it's more than that. But, if you're wondering what the hell we're talking about, just take that away from this show. Yeah. You're watching this on Sunday night or maybe even Monday morning, grab a chart of the C or S or, and go to stockcharts.com and just pull up SPY or VXF and just draw a line, right? The channel, 2 lines, I guess, right? And just watch it. See how it plays out. Yeah. And that's how you're going to answer that question, right? Yep. What do I do now? Yep. What do you do now is you draw some trend lines.
Draw some trend lines and watch. Make a decision.
Yeah. Yep. And again, I'm getting a lot of flack for this lately about being snarky. I'm not being flippant about it. It is almost that simple. Now, all the other stuff Jerry talks about, he's adding layers of data that can increase our probability level, right? But if all you can do is draw some trend lines and draw a channel there and look and see when that trend changes, right? And there's enough Googling you could do to get enough people to say a trend has changed in the S&P 500,
right?
Sure. Or in the S Fund, to help you make that decision, even if you don't listen to us. Yeah. So it really is that simple. I think it is.
It is, and it's really stressful, right? I mean,
yeah.
People just lost a lot of money.
It is stressful if you're watching your account every day, which again, we don't. Yeah. I don't think I've looked at my IRA account in 3 months.
I don't even look at the balance in my account when I do interfund transfers.
Right, I do.
I don't even, and I get a lot of flack for that this week too. Like, you don't care about your ROR. I don't.
Yeah, he really doesn't. He really doesn't.
I don't.
His rate of return, because it's not something I can control.
Right.
That goes into the bucket of only worry about things you can control. Yeah. Yep. All I can control is my decision-making ability, my education level, right? Am I knowledgeable? Am I making educated decisions? That's the only thing I can control. Yep. Now, how do I control that more? I get more educated. And, I align myself with people that are like-minded, and I watch what they do, right? And so I get a little validation out there, but at the end of the day, it's my decision because I may have a higher risk tolerance than you. I may have a better circumstance. I may be able to put more money in.
Sure.
All that stuff's different. Yep. How you allocate your money, right? How you make your allocation decisions comes from being an educated investor.
Yeah. Yeah. I mean, if you're just starting out in your career, say you're 5 years in and you got 100,000 in TSP, let's say, and you got 25 years to go and you're not worrying about it. If you're in the G fund right now, and those are your circumstances, you might try to catch this falling knife. Yeah, I mean, I might if I know what I know now, and I'm 25 years old. Because
all you're working with is new money.
No, well, yeah. Right.
I mean, mostly.
But I'm talking about IFT. I'm talking about let's say you're 5 years in and you got 100 grand in TSP. I might take all that and put it in the S fund on Monday.
Yeah.
Like I might have done it today.
Yeah.
Right now, I'm retired. Right. Yeah. So fast forward from the 25-year-old Jerry that knows what he knows to now, I'm retired. I'm not catching that falling knife.
Yeah, but I would argue, Jerry, knowing you weren't trying. You weren't catching you weren't catching the falling knife then.
No, I wasn't.
But I understand your point is you do have a little bit more wiggle room. Well, what you have is recovery time. Right. And so if people have watched some of the things that we've said over time. It's all about how much time do you have to recover from your poor decision, right? If in 2008, if you were getting ready to retire, and you just lost 55% of your retirement, how long do you have to recover? Or are you just going to cut your losses and retire? Or do you work for another 10 years?
Yep. You either keep working or you have to seriously reevaluate your expectations for retirement.
Reevaluate your lifestyle.
Yeah.
1,000%. And it doesn't take a 50% drop. I don't want to lose 5%. I don't want to lose 10%. Right. I'm okay with, and this is my risk tolerance. Yep. I'm okay losing anywhere from 3 to 5%. I'm not losing any sleep.
Yeah.
There's that 7% IBD was talking about, right?
Yeah.
That's big picture thinking. Oh man, I lost 7%. Okay, I'm not losing sleep. I'm out.
Yep.
Not losing 10 plus. I'm not. I'm gonna do my best not to.
Yeah.
So, hopefully you guys are getting some takeaways from this as to like, what's the answer to this question? What do I do now? You get your plan together.
Get a plan together. Make a decision.
Yep.
Move on the plan.
Pick your methodology,
and then evaluate and change directions and keep moving. That's all you can do.
Right.
The two alternatives to that.
Yeah.
You can either do nothing and stay where you are. That's no decision is a decision, right?
Yeah.
You can do that.
Right.
I don't know. No decision. What was the second one? I can't even think of what the other possibility there. But you make a decision, you keep on moving, or you don't make a decision, and the market will decide for you, and that's pretty much it.
Question slide. I knew it was next.
It was in there. Yeah. All right.
As always, guys, if you have questions, hopefully you got some value out of the show. If you did, please share it with your friends. Give us some comments. Talk to us. Tell us about what you're thinking in the comments. We'd love to hear, good or bad, as long as you're, got some reasonable articulation, right? If you just tell us we suck, well, okay, great.
I can't work with that.
Yeah. I mean, I don't mind it, but it's not going to work with.
Couldn't care less, but
yeah,
I can't, doesn't help me or anybody else.
But if you have real questions, if you have questions, give them to us. Whether you find this on YouTube, Facebook, on our website, however you get your TSP weekly update show, let us know. We do appreciate your time, and we are out of here. Push the right buttons, Conan.
You hit record, right?
I did.
Okay, good.